To hold cash today is as risky as holding equities, commodities, or real estate, according to our next guest. With some ideas of what you could be doing with your money, we check in right now with Marc Faber. We're delighted to have him in the studio with us. Of course, you are the editor and publisher of the Gloom, Boom, and Doom report. On his list of correct calls, Marc predicted the 1987 stock market crash, also the recent stock market rally post-March. So,
it's all luck.
It's all luck. All right, yes. You have it here. So why do you think that cash is just as risky to hold as equities, commodities, real estates? I mean, you talk about price appreciation as being one point. Is that the only one?
Well, basically, there's this huge debate between the deflationists and the inflationists. The deflationists that believe that the Dow will fall to 4,000 and the S&P to 400, and that bonds will rally and that we will have widespread deflation like in the 1930s. I belong more to the camp that looks at inflation and deflation from a different perspective, in the sense that in every system you can have some prices going down and some prices going up. Say, if you have a glut in consumer goods, then consumer good prices can go down. But if you print money and you have zero interest rates, then home prices theoretically could go up, or if they don't go up, then stock prices can go up, or commodity prices can go up. But in any event, your cash purchasing power diminishes over time, like the US dollar is weak. That's a symptom of inflation. It's not to have deflation really in a system, you would have to have a strong currency. As long as the currency is weak, it's a symptom of inflation. Now, I looked at several inflationary periods, and the worst investment in an inflationary period is where you print money and you have large fiscal deficits are, of course, government bonds, long-term bonds, and then cash. And the best is to have foreign currencies and commodities, but also equities. They protect you to some extent because they adjust upwards as the currency goes down.
We spoke with one of our columnists last week who said maybe we need to start printing a $1 million bill because...
Well, for sure. That I guarantee you.
He actually suggested maybe your name could be one of the names on the bill. But how low can the dollar go?
Well, it will go to a value of exactly zero eventually, but not right now. It will just drift right now, and we are oversold on the dollar, and sentiment is negative, and maybe you'll get the rebound and this and that. And the other currencies are not much better either. They're also paper currencies. But say, I think that against gold, it will continue to depreciate.
When does the dollar go to zero, though?
Well, I think looking at Mr. Obama and his administration, it should already be there. But I think it will take roughly 10 years until people really realize that the fiscal position of the US is a complete disaster. Because eventually, in 10 years' time, in my opinion, about 50% of tax revenues will be used to just cover the interest payments on the government debt. And that is unsustainable. Then you really are forced to print money.
Mark, you see the dollar continuing to decline. We've watched a fascinating correlation develop between the weakening dollar and the rising U.S. stock market.
Sure.
Is that going to continue?
I think so. I mean, if you look at the last, say, 10 years, 2002 to 2007, stocks go up, all asset classes go up, commodities go up, also real estate and so forth, and the dollar is weak. And then 2008, everything collapses and the dollar is strong. And then on February 28th of this year, the dollar starts to weaken, and on March 6th, the stock market starts to shoot up. And I think this correlation will stay.
Is there any point at where it breaks down, where stocks eventually top out, can't go any higher even while the dollar declines?
Well, that can happen, and then you get essentially very low valuations. In other words, the dollar goes down and stocks no longer go up, and so you get in real terms very low valuations. That can happen. But I think for now, I would look at stocks not to have a huge downside risk, because you have the Bernanke put. As soon as the S&P drops towards 900 or 800, he'll print money again. He's a money printer. He's nothing else. But he does that well. He prints well.
All right.
We have to give him a medal for that.
Unfortunately, we have to leave it there. We thank you so much for joining us. That is Marc Faber, the editor-publisher of the Gloom, Doom, and Boom report.